The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we are broadcasting live today from the National Association of Farm Broadcasting Convention in Kansas City, Missouri. And joining us for our market analysis and conversation today, we're very lucky to have two great minds with us who are frequent contributors here on Market Talk. Jim McCormick with agmarket.net, Mike Zuzolo with Global Commodity Analytics. And gentlemen, it's good to see you both here in Kansas City and get to catch up in person. And of course, there's a lot going on in these markets. And I think for starters, let's set the stage and think about back to Friday's WASDE report and finally getting data from USDA, getting that influence in the trade. There's been plenty of volatility. We've been getting flash sales, all these different data points now. And the markets, I feel, are trying to digest them. I mean, maybe both of you start your perspective on things. Mike, if you want to kick it off, I mean, just how are these grain markets digesting this flood of data over the last several days?
Yeah, I think going into 2026, Jesse, it seems to me that the trade and the funds especially are still focused on U.S. ending stocks, not world ending stocks, because you can't have a more stark difference between world corn versus U.S. corn in terms of being near record low stocks when it comes to stocks to use for corn in the world versus 2.1 plus domestically. Same with wheat, a very similar situation there. Whereas with the beans, we're at the second highest level ending stocks since 1994 globally, but the U.S. ending stocks went down enough to keep the market thinking that the upside was in the soybeans. So that'd be my first thought. The second thought I would have after the report is, when are we going to make the transition to a demand-led market? And I think this is where, being at NAFB today, one of the things that I was asked to talk about was the outside markets and some of the leading indicators. And I think we need three things. We need a crude oil rally, which I think would equate hopefully to a wheat rally. And that would also help, I think, keep the dollar down and keep the dollar at a discount. Those are the key major things for me to give to transition from a weather-led rally, supply-led rally that we've experienced almost all of 2025 to finally get to a demand-led rally we're all waiting on and have been waiting on for about 4 years now.
Jim, your thoughts?
Hey, Mike nailed it. The demand-driven rallies are the ones that work. Weather rallies, they're flash in the pan, they go. So hopefully we can get a demand-driven rally. The one thing I'm looking for, you talked about the data dump. The one thing that I'm looking for that unfortunately we're not going to find out where we're at for a very, very long time is the funds, because of the lack of the CFTC report. And I can't understand this, Mike. They came out and said, hey, we're going to start releasing the data, but instead of telling us where they're at right now, they're going to release data from 2 months ago, and we're not going to find out where the funds are until I think it's 2026. And I think this is critical, Jesse, because there's an interesting thing that happened, I noticed, in mid-October. If you look at the corn market, the bean market, the wheat market, they all bottomed, in the meal market, they all bottomed on October 15th. But what's even more interesting is the cattle market, the feeder cattle market, the gold market, the silver market, the platinum market, the palladium market, as well as a 2-year bond. Guess what they did? Excuse me. They all bottomed at the exact same time. And I just find it very strange that you had some strange coincidence that all of a sudden they reverse out of this bearish pattern in the corn and a bullish pattern in the metals and the meats. Was it a fundamental change? Was it just the fund deciding, hey, I'm going to do something, as the great Rahm Emanuel out of Chicago says, never let a good crisis go to waste. We are blacked out on data. We have no idea what the funds are doing, and what kind of position adjustments are they making that we don't know about, that we're not going to know about for another month and a half. And that is what Mike said. We could come in here and find out that the funds are massively along this grain complex and then shock the industry when they finally come clean. So that's the data I'm looking for, and I'm kind of frustrated that we're not going to get it right away.
I want to follow up on this because this is an interesting thing, and I think I have had this discussion with both of you here recently, on air or off air, or a combo of the two. But with kind of that void of data and those funds that are out there that really tend to drive these markets. Maybe it was a case of someone, at BlackRock or wherever, one of these large fund managers saying, hey, get your normal end of the year December positioning business done now. Do it early and rotate positions into, say the grains out of the cattle, et cetera, et cetera. So it feels like, I think that brings up the conversation of the funds driving some of these markets in ways, the algos, all those different things. I mean, your guys' perspective on that.
No, I agree. I mean, that's what we like to say, the funds versus the fundamentals. And, as an offshoot, I would say a couple of years ago, there was a talk that, well, you don't need to do analysis anymore. Just follow the charts, just follow the technicals. I reject that patently because of the fact of what we're going through right now. And I think this is where what I've said to producers in a practical mindset right now, Jesse, in this period that we're in, I think Jim explained so well, is if the corn market has got a lower yield and we don't have the ground piles we had last year like we thought we would have, we should start to see that very, very soon, given the demand base we've built up in this corn market, especially the export demand base. And we should start to see that in the cash market, in the basis market, pretty much right away as we get into the holidays. Because if we're tight on corn, it would suggest that if the futures market goes down, that basis will just continue to tighten and more and more and more, so that the net cash selling price is the same, if not a little bit better, to try and attract it out of the hands of the farmers who are going to be very tight holders until they have to start paying bills in mid-January, early February, if you ask me.
Yeah. Jim, your thoughts?
Well, the funds, I mean, to me, it's a different game. When you look at the M2 money supply, the amount of money sloshing around right now is at all-time highs. So this money is always looking for some kind of a investment. And when they get involved in our markets, they will, I believe, take it further than it needs to. And I think partly why you saw the cattle market go so high and the feeder cattle go so high, some of it obviously was the supply demand fundamentals. Part of it was just the fundamental mindset of a bull market and the funds just continuing to pour more and more money into it. And the fact of the matter is, you got a fund from BlackRock that's used to trading whatever it is, a stock, maybe the bonds, and they plow into a cattle market, a feeder cattle market, which is a much smaller contract, and they try to get out and exit that market just like they used to be able to do in the bond market. There's just not enough liquidity, and they crash the market. But on the other hand, if you look at where we're at, if we get into a demand-driven market, you get in and you throw in maybe a weather problem on top of it, you get that money that has been sitting maybe in the cattle market or sitting on the sidelines. There's a massive amount of money just sitting in money markets. If they decide that is a problem, and you start getting that money to start moving higher and finding it into the grain market on an inflation play, because right now it looks like the Fed, in my opinion, has given up on fighting inflation. They've got that dual mandate: fight inflation, support jobs. It feels like they're moving away from the inflation fight, and they're going to start increasing the fight against the jobs, which means they're not going to raise interest rates. And that potentially could be inflationary if they start cutting interest rates. On top of it, you've got President Trump talking about handing out $2,000. There's some estimate says that'll pump $500-600 billion into the U.S. economy. And we learned from COVID, when you hand the American consumer money, he doesn't put it in his bank. He spends it. So you got an inflationary story that could be percolating. You get that crude oil market start to go, and then you've got the perfect formula to really get some money into this market, and it could get exciting this summer.
We're having a conversation with Jim McCormick from agmarket.net, Mike Zuzolo with Global Commodity Analytics here today on Market Talk. I want to bring up China and soybeans. I know both of you are very keen to geopolitics. We've talked, how this all plays out in the trade, the tariffs, and more. We've been seeing flash sales reports and all this talk of what this framework is going to be. It's just brought incredible volatility into soybeans. But I think now the question moving forward is, okay, we have the framework. We're starting to see these, sales, but are we going to deliver and things of that nature? And so is it more buy the rumor, sell the fact in the soybean market right now? What are your guys' thoughts as we think about this U.S.-China perspective, Mike?
My first thought is we haven't really traded the USDA WASDE numbers completely. I mean, I think we cherry-picked some of the numbers out. And I think, honestly, Jesse, looking back at this market over the last week or so, I think we're pulling forward the South American weather market by about 3 weeks, 2 to 3 weeks early. Instead of starting it closer to Christmas time after Thanksgiving, we're bringing it forward. And I think that's a real key element to where we head now, because both Argentina and Brazil do have enough to talk about with this trade deal being signed, that the trade, I think, is back on the idea we've got to ration demand. I'm skeptical of that. I have been. I continue to be. I'm not of the view that China's going to purchase as much as we want them to buy. Why? Because I don't think they're in the same position as Japan was back in the mid 1980s, when we did the same thing to Japan to try and get their currency off the ground and get them to stop over exporting and oversupplying the export market in the world. The Belt and Road Project is the main reason why I feel that way, is they've got the infrastructure and the supply chain to utilize other than U.S. in terms of exports and imports. I think the one thing that I would say about the exports for soybeans specifically is, even with USDA taking the exports down 50 million bushels on the WASDE report, it still says they're going to buy about 21 million tons. If you're using like 47% of the total for what China we send to them, it's going to be about 21 million tons. That's not 25 million metric tons. And so I just can't get away, in conclusion, I just can't get away from the fear that we're going to have a 2018 type market, that we're going to have a slide, maybe this winter, maybe this spring, in 2026, and make it look more like 2018, just because of the fact that we haven't kept up on the demand side.
Yeah. Jim, you follow up to that, and I'll throw in too. I mean, with the rally we've had, there's been some basis improvement for some folks, especially taking up at the Northern Plains and more. I mean, there's been opportunities to better manage your risk here, but still plenty of unknowns in front of us.
A lot of unknowns. I think Mike's right. I mean, the market, I think, why do we rally $1? Like I said, I can't blame it all on China, because, the fact is that, the Trump administration said they're going to buy 12 million metric tons. That's half of what they've been buying. So, it's kind of funny when you think about how bullish, when someone says I'm going to buy I'm only going to buy half of what I thought you're going to buy. Most people would not argue that's bullish. So what else is behind it? I think it is the weather. If you look at parts of Brazil, Jesse, they've had the driest October, November in the last 25 years. And I think that's putting a little bit of weather premium in the market. But before you get too ragingly bullish on that, folks, statistically, analog-wise, the dry part of October into the first part of November statistically has no correlation to having a big crop or a little crop when it's all said and done. It is the rainfall from here on out that'll determine the size of the crop. Now, if Brazil stumbles, combined with this potential ceasefire of the trade war with China, I think it could be very, very bullish beans. But the fact is, like I said, I got to tell producer, if you've rallied up here, I think you've got to get into defensive mode. The reality is this: China's making some good faith purchases. They haven't been shipped out. This is not a signed deal. And there's been multiple times in this last 6 months during these trade negotiations, not just with China, but with other countries, where we got very close to a deal, but it never quite got solidified. And these purchases are all done by the Chinese government. They're not done by the public. They could cancel it instantaneously, and you could see what, then we'll find out how much of people really bought on the China buying.
Yeah.
One little piece of the puzzle that Jim reminded me from his comments is the crude oil market also swings back into the soybean oil market as well. And that's something we've seen pretty frequently, that if the crude's rallying nicely, that seems to be picked up in the bean oil market. It's going to be another year of policy when it comes to the biofuels. And so I will look more to the bean oil market for leadership to the upside than I will the soybeans outright as it stands right now, because I am skeptical about the exports, but I'm not skeptical about the Washington policy and the Trump administration wanting to rev up the domestic biofuel policy as we get close to the midterms.
Yeah. I do want to ask you both about the cattle market here quick, and then we'll get to some final thoughts. Obviously, with the administration and all the comments from the president and wanting to lower beef prices. And, I saw the headline that the Omaha Steak CEO said ground beef's going to $10 and all these things. And really, I've talked about this with both of you as well, kind of that mindset from the administration, okay, we lowered egg prices, let's do the same for beef, but it's not that simple. And then you get the unintended consequences, the impact on futures prices and the cash markets and more, and just immense volatility here in this cattle trade. Do we think this is going to continue here into 2026?
I would say very briefly, to give Jim more time to talk about it, is my mindset is setting up more and more that you have two opposing forces working on the cattle markets right now. One is Wall Street, and that's your consumption base. And if the 401ks and Wall Street suffer and we correct substantially, what if Wall Street does what Bitcoin is doing right now? What if gold follows through? And then what if the dollar catches a bid and all of a sudden becomes a safe haven again? I think that will probably work against the idea of being long if you're a fund in the cattle market. May mean nothing about the cash market, but it could do a lot to the board price like we've already seen. The other opposing force is what's happening with the winter weather. If we have a bad calf crop season this winter, I think the doors could come off of this market again, because this is our only chance to rebuild our herd for the next 30, 40 years, in my opinion, unless we bring in a lot of Mexican cattle, more than we think we have. So I'm getting out over my skis a little bit when it comes to the winter weather, because it's early yet, but I can't express to you, if we have a 53-year low in the cattle herd, how significant this cattle and this cow-calf crop is going to be for next spring and this retention.
Jim, your thoughts?
We got into this problem over years. It was a multi-year drought in the plains. It forced liquidation. It's going to take years to get out of this mess. It's just, you mentioned the Trump administration, the eggs. The eggs are a different game. That was a bird flu driven situation. You get an egg farm that catches bird flu, they clean it out, they got to let it sit sterile for 5 to 6 months, bring that production right back up, and they're going again. Mm-hmm. You can't do that. You just can't bring cattle expansion on that quick. So it's going to take time. The market's pricing goal is supply demand is, what do you do when you need a tight supply? You drive prices high enough to either A, expand, which we're trying, but it takes a long time, or B, you got to ration demand. And right now, Mike said it best, if the stock market starts eroding and really taking the confidence of the market away, jobs markets go away, you're going to see it. But right now, we've kind of seen a K-shaped recovery. If you're in that bottom half of the economy, you're struggling. This $8, $9 pound ground beef is killing you. Mm-hmm. But if you're at the upper end of the high end of this, the bracket, where in general the stock market's been relatively good, house assets are really good, they haven't pulled back on it. And the other problem is just this, where we're at as a society. Mm-hmm. There's a lot of people now eating protein, and the reason why it has to do with these diet shots. Mm-hmm. The reason why, when you take the diet shot, what a lot of it, the doctors tell you need to eat massive amounts of protein to essentially keep your muscle mass up. So that's why you see everyone eating protein. That's why you find protein in everything. I think there's even protein now in Gatorade. That's just part of the deal. So you're trying to get a dynamic of supply demand equilibrium. Mike's right. I mean, the market's trying to encourage people to expand herd, but we have a really hard winter for some reason. It's just going to delay the outbuild for another full year.
Gentlemen, this has been a fun discussion. Final thoughts as we look ahead to 2026. We're going to get seasonality and quieter markets here. We presume over the holidays we traditionally do. So, thinking through the holidays and looking ahead to next year, what would be the final thoughts you would share with producers? Just what they need to keep an eye on, Mike.
Just circling back around, keeping it simple when it comes to, if I'm not a believer that China's going to buy a lot unless we have a really bad weather market in South America from the United States, I should say, keep your eye on soybean oil and get beans hedged ahead of corn. Acreage base is also a very big concern as we go forward. And if we're going to have a long-term low, I think it really needs to start with the wheat and the crude oil market, because the trade's convinced at this point, in my opinion, Jesse, that there's an oversupply of both, and why rally at this point?
Jim?
It's going to be interesting. I mean, we've had a second, third year in a row, we've seen equity being taken away from the farmer. 26, it looks like it could be setting up to be a little bit more challenging year for a fourth year in a row. The bean market rallies definitely helped out a little bit. The good corn yields for certain people have definitely helped to break evens. But as you get into 2026, I think it's going to be very, very critical to drive down and find out what your break evens are and what it's going to cost to put this crop in the ground. So when you have that opportunity to market profitable, you can market when you have the opportunity, as opposed to being forced to market when you have to generate cash flow, which tends to be at the wrong time of the year when the markets tend to be soft.
Jim McCormick, good to talk with you, sir. Thanks for being with us.
Thank you.
Mike Zuzolo, Global Commodity Analytics. Always good to see you, Mike.
Thank you, Jesse. Appreciate you having us.
Jim McCormick with agmarket.net. Mike Zuzolo with Global Commodity Analytics joining us here at NAFB in Kansas City, Missouri, here for Market Talk. I'm Jesse Allen.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.